Ladies and gentlemen, thanks for tuning into The Scoop. I'm your host, Frank Chaparro, Director of Special Projects at The Block, and we have a very exciting episode of the show for you today. Joining us on the other side of the mic, founder and managing partner, Soona at Volt Capital. Joining us for the second time. We love a repeat guest on the show, especially because it helps us think about how much has transpired in this fast-moving, sometimes overwhelming space of crypto and digital assets. The last time you joined, I don't know if you remember, it was in San Francisco at that Circle conference that they did. And you talked about how the center of gravity had shifted in the crypto venture market. I might say we've probably fallen to a black hole at this point, almost a year later. So let's just start there with how the VC landscape looks given your seat. Describe the state of crypto venture.
Yeah.
How have things been?
Well, it's great to be back on, Frank. Yeah, we are no longer in San Francisco. We're actually now in New York. So things have been changing a little bit, which is also...
The center of gravity has moved to New York.
And again, I was just about to say, in this last year, we saw a large part of SF largely write off crypto and have shifted their focus to AI. And the heart of crypto really seems to be in New York now. I'm pretty sure SBC this year, like the Stanford Blockchain Conference, is, I'm looking this up as we go because I want to make sure I don't. I'm pretty sure it's going to be in New York City. It's in New York City this year. They've rebranded the Science of Blockchain Conference, but I think that's just, SBC was always held at Stanford. This is the first year it's going to be in New York. So that's one item to point to. But we have been so busy. The number of founders that we've been seeing over the last 6 months ahead of the halving, 7 months ahead of the halving, all came out of the woodwork. I think there's been enough time diversity in the market where we see new narratives emerge that founders just feel like there are more and different things to build. I think a lot of the projects that were in build mode in the bottom of the bear market started showing green shoots. We saw launches like EtherFi receive quite a bit of success, and that's motivated this spring of founders to start building. So it's actually, it really is not a black hole. It's the busiest it's been in a while, really.
I guess I was more so alluding to just the pressure that we might feel from the surge in activity. I'm sure you're seeing it on the deal flow side. We certainly see it in the headlines here at the Block and manifested in our deals portfolio, or rather dashboard that we have that keeps track of these deals. And I think when we first launched the dashboard, not to shill it too much, but I think I am. But, you maybe saw 2 a day kind of hit the wire, then sort of 3 a day, 4 a day. And it seems like the number of deals being announced is happening at an increasingly fast clip. Last time you were on the program, you talked about this new wave of entrepreneurs. And that is, I don't want to opine or pontificate too much, but it's been super nice to see just a lot of fresh faces, just from an individual perspective, just meeting new people, talking to new people with new ideas. But how is that manifested into new narratives, right? It's not just new people, it's new people doing new, different types of things. When you were on the program last time, you talked about this enthusiasm for investing in projects that were developing second order use cases. So we had all these platforms. Maybe you then had founders come to market to maybe provide security or analytics for these platforms. Has that manifested? And what other narratives maybe have you seen come to market?
Yeah, absolutely.
Layer ones are still exciting.
Layer ones are always going to be exciting. So the second order use case is absolutely true. And if anything, and I'll show you what the zeitgeist has been here, it's been Bitcoin L2s. So think about it. we saw hype around ordinals. Okay, we saw a few advances, right? We saw the ability to, we saw upgrades with like Taproot. We saw some upgrades like with actual Bitcoin Core. And then we saw BitVM, and we saw excitement around ordinals and the increase in activity around NFTs on Bitcoin when Bitcoin is net worse from a data storage perspective than Solana or Ethereum would inevitably, like if you were in the driver's seat, like really thinking about what are the second order effects of this, it's immediately like a Bitcoin L2, right? To offload a lot of that data burden that's coming with all this activity of these Bitcoin NFTs. And so we've seen this just rush to invest in all these Bitcoin L2s. And that, I think, is probably the most canonical example of that thesis really playing out. We're also seeing narratives around crypto and AI to do multiple different use cases within AI, everything from like inference, training, agents. I mean, it really runs the gamut, synthetic data as well. And we're seeing a resurgence in interest in DePIN projects. And what's interesting is I was seeing a little bit of rhyming between what's going on in traditional Silicon Valley and crypto. So we're seeing interest now in DePIN robotics plays. And if you look at what's going on in San Francisco, it's a lot of people perceive AI to be the brain, and the substantiation of that, or the body or embodiment of AI, would be robots to give the brain a body. And you're seeing a lot of these founders who need to.
Do you listen to Odd Lots with Joe Weisenthal and Tracy?
Of course, yes.
So they had a show. I think I was listening to it yesterday when I was driving, where they they kind of we've seen so much growth and expansion in generative AI, obviously vis-a-vis ChatGPT, and I think it was Joe or Tracy, I can't remember. Their senses of humor are so intertwined. Or one of them said, "Well, what happened to robots?" When Tracy's like, I think it was Tracy. She said something to the effect of, it's fun to recreate song lyrics that are, or spoofing something with generative AI, but when am I going to have a robot that vacuums for me? And I just.
And you quite literally had Nat Friedman tweet out that he wanted a robot that just picked up single leaves at night. Did you see that? And someone built it. He just tweeted at it today. He would fund somebody to build it, and someone shipped it. It's pretty funny. No, they're here. So they never went away. They're here. So some of the emerging narratives are crypto AI, DePIN, and DePIN in various use cases that we haven't seen. They're really pushing the envelope, like in aerospace, robotics. I mean, sometimes it does sometimes look a little bit like defense tech, or rhymes a little bit more with American dynamism. Bitcoin L2s are big, and AVSs and infrastructure that's being built around these restaking protocols. So those are the major narratives that we're seeing founders build around. I also have another thesis I talk about, which is outside of second order effects, is to index on narratives that did very well the previous cycle, crashed so hard in that cycle that people wrote it off to irrelevancy, and we were almost embarrassed to talk about it because of how badly it crashed. And one canonical example of this, of course, was CryptoKitties. When NFTs were first getting started, CryptoKitties crashed. And I remember when we used to run Token Daily, we used to do this predictions post annually. And we would ask like 50 or 60 leaders in the space what they thought the next year would hold in terms of breakout narratives, breakout companies, products, whatever. And I think only one person that year said NFTs. And the next year, everyone was talking, like the predominant narrative was just NFTs. It was OpenSea, it was Magic Eden, it was like all of these, the PFPs that took off. And so I'm always cognizant of and we saw this also with AMMs, like with Bancor, with Uniswap. It's just these things that preceded the breakout, the real breakout company or breakout game or breakout application that then come back with a vengeance and end up becoming the predominant narrative. And so when you think about that for this cycle, and this is why I alluded to the game, is last cycle, when I think about something that was doing incredibly well, and then network effects unwound just as quickly because it was a heavily network effect dependent product, was a lot of the play to earn games. And we're seeing this resurgence of interest in these kinds of projects, and it looks like play and earn. We're already seeing games like Pixels and Parallel. Like if you look at Ronin, like activity is up and to the right again. So that's definitely a narrative to be watching out for this cycle.
Yeah, it's interesting that you're bringing up sort of these different trends from the previous cycle. I feel like the NFT GameFi wave gave way to. I feel like there's been more attention focused on AI, RWAs, which we didn't hit yet, and well, really AI, DeepIn to an extent. They're kind of interconnected. But you're sort of saying that don't ignore what we had, sort of, being built out maybe 2021, 2022, still worth paying attention to GameFi, NFTs, and the like.
So it's not just on the defense. It's not like don't forget about these. It's actually pay extra attention to the things that broke out and unwound just as quickly, because those flashes in the pan, those are the things that oftentimes will play out with more substance and more robust infrastructure in the fullness of time, aka the next cycle.
Is this one of the most challenging aspects of being a venture capital allocator? Is not chasing the next shiny thing from cycle to cycle?
Yeah, temperament is the most important thing when it comes to investing. It's knowing when to be excited about something when there's something really there, and getting excited about something even without any social validation or consensus amongst your co-investors even, let alone the public. And you can just keep your wits about you and keep a cool head. And if you genuinely enjoy the product, you think it's a strong founder, just betting on them. It really is. It's remembering not to trade off short-term validation or social acceptance for what will long-term play out or where the market will eventually meet a founder's vision. And the luxury of crypto is that you can do both. So you can invest in companies that people are getting excited about now, that can materialize within this cycle. And you can also switch gears and think about what do we think will be popular in 2 cycles from now. And the reason you can do that, and why is this a special time to do that, and it won't always be true, is because we're so early and because there's so much iteration going on. Like we really haven't cemented exactly like what the vision of crypto is, what the primary use cases are. And there's still so much experimentation happening. And if you look at just how organizations, like humans, animals, like institutions, countries, they all scale in a similar way. You think about the first few years of anything's life, and there's a tremendous amount of change happening. And then eventually it plateaus. So like, 30 to 45-year-olds look the same for a while, but like a 3-month-old versus an 8-month-old look very different. Same thing with organizations, companies, whatever. And I do think the same thing with narratives in emerging markets. It's like you get this rapid iteration, rapid cycling, and then eventually things start cementing a little bit more and you get more incremental improvements versus these big swing bets. And that's why you can do both in cryptos, because the narratives run through so quickly, the velocity of narratives it does, that you can take 1 cycle bets and 2 cycle bets.
Do you know what I think this is most manifested in, at least for me, or where I find this phenomenon that you're describing most visible? If you rewind the clock to 2017 and you think about that whole Cambrian explosion of companies operating within what we called security tokens back then, all flopped majorly. You had a few companies that have survived through the wind and fire, like a Securitize, for instance. But if you remember back then, there were firms that were trying to do private deals with tokens, trying to tokenize college dorms in South Carolina and ridiculous things like that. And then fast forward, right? I mean, stable coins back then, which are RWAs, in a sense, people don't think of them in that way because of how they're used, but as a payments mechanism. But back then, what supply was maybe $1 billion, maybe it was like $500 million, and now it's over 100 billion with Tether alone. Point I'm making is the idea of RWAs, we didn't call them that back then really, have kind of come back, and now you have all of this experimentation with sort of different approaches to tokenizing or offering some form of exposure in a tokenized way to government bonds, US treasuries, everyone with their own sort of approach. The point I'm making is, in a sense, right, like this, I was thinking the other day, like, none of those are going to work unless the entire structure is changed. Like, you can have an issuance of a bond on Ethereum by one party, two counterparties, they can do something. But you really need to have, like, you're not going to have multiple multi-billion-dollar companies, issuing a bond unless from end to end, their back end and middle ends, middle office infrastructure is completely on chain. And that's just either going to happen or it's not. And it's going to happen very, very slowly. And then you're just going to sort of move all at once, as they say. And I think that's like kind of the point you're making, right? Like, you're going to have these little instances of experimentation, many of which are going to fail. And then the paradigm changes, where all of capital markets are now on chain. But you can't really see it until it happens, right? Because you're not really going to care about these stupid one-offs. Even something like BUIDL, which is super cool. I mean, at the end of the day, BlackRock just wants to eat a bit of Circle's lunch. It's not transforming capital markets, but it points to that future that's going to happen very slowly.
Yeah, like, I mean, look at Webvan versus Instacart. Like, Webvan totally face planted, and it was really just a timing question. It was like the actual product made sense. It's just the infrastructure wasn't there, and enough people weren't online. People still loved going to get their groceries, like to go shop for their groceries, and the timing wasn't right. And sometimes it quite literally is just, are enough people on chain? Has enough info been built out? Has people's lifestyle changed a little bit to give a huge amount of leeway or a huge amount of surface area to bend and change the way they might behave online or in real life? RWAs in particular, they're kind of like NFTs in that it's like one three-letter, like little alphabet soup, three-letter acronym to describe something that it's just a huge and wide variety of assets. There's like T-bill.
Did you want to say shit ton?
We can keep it. Quick.
Yeah, PG.
We'll keep it PG, or rated G. But the idea is that it could be T-bills, real estate, it could be physical consumer goods. It really runs the gamut. And the things in place for RWAs, it's like, not that it's usually a technically difficult problem. It's that you look at these teams that are hundreds of people big. When you look at tokenization of real estate, for instance, and the engineering team is a real small fraction of that. And the rest of it are like these huge behemoths of like in-house legal teams to overlook recourse and like, how is that going to work? Insurance. And it's a lot of these other things around the tech. But it's a bet worth making, because when you unlock those industries, you're unlocking a very, very meaningful portion of the world's capital.
I was speaking with this gentleman who runs a credit fund at a hedge fund in crypto. They said that they can do 70% of what's done in debt capital markets through smart contracts. But to your point, and to my point, which was more long-winded and less eloquent, that's either like everyone needs to get on board with it. Like if everyone doesn't get on board with it, then it's not going to really happen.
Yeah, and you just need a meaningful number of people to get on.
Yeah, not literally everyone, but like,
it may be, and
there's a network effect.
Yeah, and look, the left curve approach to most of these things is think about the system as is, and think about the number of bodies being thrown to change the system, and think about new generations entering the workforce, entering the economy, and these things just over time. I usually think the more active system, the people actively changing and working towards something, will over time eclipse and overtake the status quo. That's just pure left curve approach to how innovation happens over time.
To what extent do you think A16Z often, tries to differentiate between these hype cycles as well as these innovation cycles, right? The innovation cycle continues to sort of, make its upward trajectory, whilst hype sort of is more cyclical. How does sort of the state of the world, the economy, geopolitics impact what you do on a daily basis as a long-term allocator of capital in private markets? I think many people are worried, right? I mean, you look at the staggering debt. It's something that we don't often talk about on this show. Just cost of living, geopolitical tensions, uncertainty with the upcoming election. How do these things, which are very not, crypto related, impact the job that you have? It's a bit of a tangent, but I am going to ask anyway.
I would actually push back and say it all is crypto related. If you think about crypto as a coordination system at its very essence, and how to incentivize people around that, geopolitics affects it, regulations affect it, and a disappearing middle class wherever you may be deploying your project also affects it. So with early stage investing, look, like we want to work with regulators. We trust that they aren't going to want to stifle America's number one export, which is technology and technological innovations, like really everything that we've offshored. That is what cements our position as a hegemon. And we trust that regulators understand that and aren't trying to stifle the ability to build and to continue our influence on the global stage. That said, things like a disappearing middle class and things like a broken economic system is, again, the reason that we're here. And also the reason that there seems to be a strong tailwind around why crypto is attractive to these younger generations that are like, wait a minute, I can't afford a house like my parents did. I actually make less money than my parents did, or like it's quality of life that's getting worse over time, generationally, than better. And there's this trope in crypto, and it is true, where you think about putting your money in a retirement fund and knowing exactly the meager savings and returns that you're going to get roughly, versus any chance at meaningful upside is what causes. You've seen the amount of people participating in lotteries alone. I mean, that's up and to the right. And to me, that's desperation for this desperation reflective of what it's been to operate in our existing economy. And people are looking for ways to generate meaningful upside. So this ends up being a massive tailwind for our sector, where we're like, look, in using these products you use every day, we can distribute some of, you can also participate in generational wealth creation. And every generation, with the advent of VC, going from traditional East Coast banks to VC, with startups, just the idea of giving initial engineers equity within the company, the next phase of that evolution is then giving users shares or equity in that company in the form of tokens that these platforms are then built on the backs of, right? So it's just a natural progression. All of these macro climates do affect us, and they're tailwinds and headwinds that we bet for and against as we're making these bets. That said, they happen a lot more slowly. So so it's not like it changes from a week to week basis, and we get to realize our thesis over a multi-year time horizon. But it's something that the space is betting on.
Yeah, it's interesting, right? I mean, these different macro headwinds, the hollowing of the middle class, in a sense, serve as both a catalyst or a tailwind for crypto and a headwind at the same time, I think is part of the point that you're making. I think it's interesting that you brought up the surge and the sort of like underpinning desperation that exists in our world today, that has led to, you know, more folks hitting the slots, as it were, in both traditional and new forms like meme coins. Are meme coins a derivative of sort of this financial nihilism, or is there something there?
It's a little bit of financial nihilism. I have been observing the meme coin phenomenon and
the discourse.
Yeah. So on the surface, it's unattractive, right? Oftentimes it looks like scrolling through 4chan. I mean, there's a lot of things that are unsavory about a large part of meme coins, and I'm not out here peddling and saying this is the product of years and years of cryptographic computer science brainchild of all of this mathematical geopolitical work that's been all of these different this is not the brainchild of the science that went into, and the science and the math that went into crypto. What it is,
this isn't what Satoshi intended, in other words.
Not what Satoshi intended. So I view meme coins like Wall Street bets, where it's, to me, an indication that retail is getting more sophisticated, which does seem like a juxtaposition because it's meme coins, and so you don't really conflate memes with sophistication, but it is retail getting more sophisticated. They are realizing that in quite a few instances, many people are able to enter crypto projects at a pretty attractive price. And particularly when founders are dishonest about long-term intentions of the project, they will dump on the public. And I think retail is just getting pretty tired of it and are taking matters into their own hands, where they realize there are these low cap meme coins where they can partner with their friends on Telegram or on Twitter and create a culture around it, memify it, and the reward for their ability to bring a meme to life is that they all get financially rewarded for it, and they're flipping and making profits. So really, really similar. It does remind me a lot of Wall Street bets. I think it's just, I think it's more of retail becoming more sophisticated around how to profit from some tokens. But that's,
yeah, I think it's a good point.
That said, I would discourage people from making meme coins such a big deal and intellectualizing it, because the more on either side of it, but especially people who are against meme coins talking about it ad nauseum, it really is a Streisand effect. It's only going to grow bigger. It's only going to become more important in the space. The more you talk about it, the more you highlight it. If it's something that you don't want to promote as the brainchild of all of crypto's efforts, I think people are having fun. They're making money. They're trying to see what works, what doesn't in this space for them to profit. And they're probably, again, this is probably born of a tiredness of being dumped on. But yeah, but I think there's just so many more important things to focus on, that let people have their fun, similar to how Wall Street bets doesn't take up most of my mind share on a day-to-day basis. When I think about my portfolio holdings and public stocks, I similarly don't really, or penny stocks really don't really register for me much. I also don't pay that much attention to meme coins in general. I think it's let them have fun. It's entertaining, and they're having fun with volatility.
I guess your pockets aren't exploding.
I cannot say I can't make meme coins or participating in that ecosystem, but it's fun to observe from a distance.
Let's maybe then pivot. How do you think about? Put this in some questions that I sent over to you, because we've been meaning to talk about it on the show. Just the changing changes that maybe you might be observing in tokenomics, especially since you began the firm. We're almost at 4 years now, right?
Yeah. It's been 4 years. So
how are you seeing projects approach that? And obviously I think you can think about it from the perspective of fee generating versus pure governance. What happened to governance? I feel like we don't talk about it as much anymore.
So there's a couple parts of that question. So the first one is what's happening in tokenomics in general. And the actual biggest innovation that we've seen in the last year is points. Points was the biggest unlock for tokenomics. So before points, and I don't know if I need to give context on what points are, but they're just a way to reward users on your platform with doing it off chain. So you're using a centralized database to issue rewards, usually in the form of like off chain or centralized database tokens, and you're rewarding users for specific actions. And
I mean, they're just like loyalty points. I mean,
it functions similar. It can function similar to loyalty points, but what it's really doing is it's allowing the founder to get a sandbox in terms of what KPIs do they actually want to be optimizing for, what actions do they really want to be incentivizing with their platform, and what are the knock-on effects or second-order effects that result when they optimize for a certain. And so in the past, when you've actually launched a token, like you better have hoped and prayed that like that long-term is the action you want to incentivize, because the amount of resistance and friction it took to change what what people were rewarded for in the platform, what the token did, you had to get a lot of consensus from existing token holders, or however your governance was constructed. So it just was very, very tiring. It was very hard to innovate. It's like introducing just how sclerotic like these big institutions are prematurely into a project just because they launched on mainnet or just because they had a token generation event. So I like to think of points as a testnet of a testnet, where all of a sudden you're able to A/B test what users can do, and they get to help you get feedback. And it's also sweetener is that it also helps with growth. So that's probably one of the best unlocks. It has meant that people delay token launches a little bit longer, but the trade-off then is that they're more intelligent about the kinds of behaviors they want to incentivize. So all in all, outside of any risk of founders not honoring the point system, because again, this is off-chain, so you don't know. It's not like a blockchain. You don't know how many points are allocated. You don't know what the founders intend to do when they actually tokenize. But that risk aside, it ends up being a huge advantage for, I think it was just such a positive unlock for the space. And with regards to fee generating tokens and governance tokens, I mean, people aren't listing them by name as governance tokens, but many of these projects, when you look at some of the like restaking projects that are launching now, those are largely governance tokens versus optimizing for fee capture. If you look at DePIN projects, you look at DePIN Ninja, for instance, which gives you the ability to see revenues that are being captured by tokens versus what the market cap is for that protocol. It's very indicative of how optimistic people are around what the protocol is going to end up doing, because it's not like a 10x difference. Like in some instances, you're seeing like 1,000x. So I think that's just optimism around how early the projects are versus the anticipation about how much they'll grow.
That's a fair point. it's interesting. I feel like another way you can think about points is it's like in capital markets, you have like something like NASDAQ private market, maybe before you then list on the exchange and have your big market debut to sort of test things out, test the appetite of what the marketplace looks like. And it kind of also, one thing that you didn't touch on was sort of the extent to which it might dampen sort of like predatory or very like mercenary like behavior, which, is fun when you're, setting up and sibling like across 20 different wallets as the airdrop receiver, but it can be not productive. One thing that we mentioned, right, and we talked about it with Hasib at Dragonfly when he was on the program before Easter, I think it was in March, was because he red pilled me on points. I did not like them because I'm a mercenary. No, I'm a reformed mercenary.
Look, points are neutral.
Okay. They're neutral.
They're a tool. And the value of a tool is how it's used, right?
Yes. We also talked about layer ones.
Mm-hmm.
And I think that, again, I think you said this before when we were sort of trying to get on the horn. We're never going to have enough of them. And he's like super in that camp where he thinks there's going to be like thousands of blockchains or something insane. But how do you think about that? Will enough ever be enough?
I think that people will continue investing in L1s. The upside for a successful L1 is just so massive that it is rational to not at least try to bat. So when you look at the outcome, when you look at potential outcomes, it's just a point of just like, as a rational actor, like, does it make sense to take a bet on this given what the outcome could eventually be? That I don't see them going away anytime soon. There was one last point I want to make about tokenomics is Lauren Stefanian at Pantera did an excellent write-up on benchmarks because there isn't a lot of clarity around what the averages are for distributions. And she did a retro on 2023 numbers and found that typically projects are allocating roughly 24% of their token distribution to the team, 20% to investors, and roughly 20% for airdrops. That
kind of makes me think about this whole Renzo drama, where you had the pie chart that rang. Yeah,
we had a crime.
Yeah, it was a chart crime in the truest sense of the word. How do you, maybe think about or provide guidance to projects on striking a nice balance between providing value to those core contributors as well as early team members and then community and other participants?
Look, the pushback, the surface level pushback that Renzo received was that 65 to 70% of the token distribution went to insiders, and that this was unfair to the community, and that was actually not the reason that most people were upset. If you decide to allocate 65 to 70% to insiders, okay, that's fine. If you as an ecosystem, if you as a user disagree with that, go to another LLC. Like, you don't have to use this concept. If you disagree with that, like, that is, you have the freedom to go wherever you want. And if that's what they want, that's how they want to incentivize their team. That's how they want to incentivize their investors, whatever. Have at it. Like, the market and users will decide whether or not that drives with them, and they'll vote with their with their laptops or whatever they'll vote with their wallets, right? They'll
vote with their wallets. Yeah,
exactly. They'll vote by moving to different products. The real problem was, and this is why it became so inflammatory, this is what you're alluding to. I don't know if you're going to show this on I need to pull it up. Can you show on the video when we actually launch it? It's like that that pie chart, all the numbers are reflected, so you probably can't even see it, but this 25% slice is supposed to be representative of over 30%. This quarter, these are 2.5 and 2.5% and cumulative 5 equal to 20%. Like, the problem was that this was insulting. And I think that's actually why people were so upset, is because
how does a mistake like that happen? Is that just like, you got to think,
there are chart crimes where you'll have founders or companies send you users, and they don't send you users that are a snapshot of like daily active users or monthly active users. They'll send you an aggregate charts, like, and it's always up and to the right. It doesn't matter. Like, it's just always going up. And that is at least understandable, but truly, like, yeah, this was just unforgivable. And that's why the community reacted with such intensity. It was just really insulting people's intelligence. It was, I think there's like this immune system reaction in the space to people rugging or lying. And it felt like that, to see the pie chart so massively misrepresent what the allocation actually looks like.
It was quite egregious.
Exactly. Yeah. And that it was a comms crisis. I truly believe that them distributing tokens the way they did would not have had the reaction it ended up getting if that pie chart hadn't been published.
Yes, because it's a bit of it was a bit of the lady doth protest too much, right? Where it's like, why do you feel guilty to the extent that you need to configure this in such a way?
No, exactly. Yeah, that was the cardinal.
Yeah, it was unforgivable. No, maybe we'll forgive them. They'll have to pay their penance. Well, this was such a fun conversation. We need to have you on more frequently, and I'm glad we had more time. Last time was not enough. I think we only recorded for 25 minutes. Where do you find yourself? We'll end with this because it'll allow you to sort of, sometimes I ask the last question and then we have another 20 minutes. Where do you find yourself being contrarian? How is the house contrarian relative to your peers?
And
right. You have quite a few. There's so many VCs. It's hard to keep track of.
So it feels that way in crypto, but you look at how
big. There's actually not that.
Yeah. Relative. So
there won't be too many until I launch a fund. Then there'll be too many.
We heard it here first. So with regards to how we're contrarian, actually saying what we're focused on and kind of giving that up would probably like, here's a better approach. It's what's consensus right now, instead of like showing our cards in terms of like what we're actually indexing and what we're looking to invest in. A good thing to think about is what is consensus right now. And it doesn't mean that they're wrong. It just means that they're consensus. And then pick out what are, one, the narratives that are quiet, like what people aren't talking about. And then two, what you just think is not going to play out, period. And Vance from Framework had an incredible tweet on this. I think he did such a great job pointing out some of the few points.
He's been so fire on social lately.
Yeah, he really, not like he's been fire on social, but like he definitely, forever, yeah. Come on. So he has a few points. He lists a few points of consensus, and it was so funny because these were a lot of the same things I was telling my team is, one, the Bitcoin super cycle, or at least like the emergence of all these Bitcoin plays with like Bitcoin L2s. We're seeing some Bitcoin, some things around Bitcoin Mev, Bitcoin NFT platforms. Solana winning the chain wars is becoming more consensus over time. It's definitely a louder voice in the room, whereas people were really quiet when Solana had corrected and crashed post the FTX crash. Ethereum being dead, or Ethereum not living up to its promise, is becoming more consensus, or is hard to see where it goes from here. Not saying it's true, it's just some things are louder. People are pretty quiet on gaming. And as you know, like, especially like with our Pixels investment, we're really bullish about the future of gaming for crypto. That DeFi isn't going to be able to scale, like really on a global scale. We have not seen it stress tested in the way that our current financial institutions work. And that, and then I think maybe one place we differ is that he thinks the point of consensus is that consumer is dead. But and that's true for Web2 and traditional folks looking in, but within crypto, we're seeing a ton of founders starting to build.
GameFi, games, pay attention to games. What happened to that? We'll have to have you, maybe we'll have you come on. We'll get folks operating that segment. We can do a whole gaming episode. That, we haven't done that in ages. We had Jeff Zerling come on quite a number of times. He's our portal to that world, as it were, over at Mavis.
Yeah, so definitely gaming is more of a, so to be sure, like we aren't like a gaming focused fund. We invest in both consumer and infra. It's just when I think about more the contrarian takes and where I think that people aren't being as loud as they should be, whereas they might be in 6 to 10 months, gaming is where people are pretty quiet.
Yeah. So pay attention to that, folks. Thank you so much for joining the show.
Thanks so much, Frank. Always a pleasure.
Always a pleasure. Where can people find you and maybe learn more about the fund?
So our Twitter is Volt Capital, VOLT, capital CAPITAL. I'm Soona on Twitter, SOONA, and they can reach me at Soona at Volt.
You have the Soona? You just have Soona?
I have Soona, SOONA, yeah.
Nuts. Good for you.